Hi everyone, thank you for joining us today for our webinar on Quantopian's improved backtest analysis. Our speaker today is Abhi Kalyan, who is the product manager at Quantopian, currently working on improving the backtesting experience. Recently, Abhi also helped launch Tab Complete in IDE and the risk model in algorithms and research. He previously studied software engineering at McGill University and can write this bio in verse if you ask nicely. So I'm going to hand it over to Abhi, and like always, I just want to remind everyone that we are recording and we will be taking questions at the end, so just type your questions in the side. Thanks, Abhi.
Hey everyone, I'm Abhi. First of all, thank you all for taking the time. Appreciate you making the time for this. Before we get started, I just have to show you a short disclaimer, which should be on my screen right now. So, this is in no way investment advice, and take a moment to read the disclaimer. And without further ado, I think we can get started. So, a little bit of background before we jump into things. Some of you probably know that we launched a new contest in February. And there are a bunch of things about it that are exciting. First of all, you get paid daily. There is a prize for 10 winners instead of, just a smaller number. And one of the biggest things that we've done with this new contest is that the criteria that we've chosen will help you on the path to an allocation. So we made sure that if you meet the contest criteria, you're probably in a good place. However, this also means that entering the contest is now a little more difficult than it was before. Because now you have to think about things like position concentration, like risk model exposure, trading liquid stocks, and a number of things. So this makes it a little more tricky to enter the contest. And one of the things that we launched very recently is a new tool that helps make it a lot easier for you to meet these criteria. So you can see as you develop your algorithm, how many of these criteria am I meeting? You can know what you need to do to meet a certain criterion and how you can get to the point that you need to get. And the goal is just to make it a lot easier for you to meet all of these criteria and get into the contest as quickly as you can. So to start with, let's take a look at an algorithm that I wrote. So this is on sort of the old version of the backtest page, and let's hop over to the new one. So this is an algorithm that I wrote. I want to get it into the contest. And initially when I see this, part of me is like, wow, 165.85% total return. That number looks great. And we can even sort of drill down on portions of that to see that that number seems to be doing really well. But is this really that good an algorithm? We can also see that it doesn't meet any of these risk constraints. It doesn't meet both of the structural constraints. And what does that actually mean? So we can start by clicking into one of them. Let's start with structure. So we can see that this algorithm would not get into the contest because while it does use the optimize API to order, which is the way we recommend that all algorithms place their orders today. So you need to use order optimal portfolio, which this algorithm does. It doesn't use the Quantopian tradable universe, which is a big drawback for the algorithm. The reason why that's important is because we want all algorithms to be trading within this universe of liquid stocks that are easy and practical to trade in the real world. And that universe is pretty large, but we do expect that algorithms trade within it. So obviously this algorithm is not meeting that. And then if we hop over to risk, we can see just a lot of X's. It seems like there are many criteria that I'm not meeting. So taking a look at my sector exposures, it seems like I'm over the max limit for financial services, and I am over the max short limit for basic materials and for energy. So it looks like I have too much exposure to certain sectors. Some of them seem to be within the criteria, but others are just a little higher than I would like. One thing that's useful here is you can drill down into certain exposures. So you can say toggle some of them on and off. But the main takeaway here is that I am pretty significantly overexposed to 3 or 4 sectors of the economy, and that's risk that my algorithm may not want to take. The same thing is also true of investing styles, not just sectors. So taking a look at my algorithm, it looks like I have a very strong value investing bias on the long side. On the short side, I'm pretty short the volatility style factor, which is essentially talking about the difference in return between an asset that's high volatility and an asset that's low volatility. I also have a little bit more exposure to momentum than I probably would like. The other two, which are size and short-term reversal, which is you can think of as a variant on mean reversion, but those two seem to be within the bounds, but the other three are just more than I would like. Looking at leverage as well, it looks like my algorithm is controlling its leverage fairly well for maybe the first year of its life, but then it dips below the minimum leverage constraint out in 2015, and that's not great. So that's hurting me there, because as we can see, it says that to be eligible for the contest, I need to maintain a gross leverage between 0.8x and 1.1x. And if we click on Learn How, we can see why each of these things are important. So, for example, with leverage, we say that the upper bound is in place to make sure that you're not investing too much capital, and the lower bound is making sure that you're mostly invested in stocks and not just sitting on a lot of cash. So, going back to that algorithm, we can then see my turnover, which talks about how much trading I'm doing. So with turnover, actually, I have a different problem, which is that I'm trading too little. And the minimum limit is 5%. That's a trailing average. But at times I seem to be dipping under that limit. I'm doing around 1.5% or a little bit around that. So that's often not a good thing, because it means that I may not be sort of refreshing my book often enough. And it's very hard for us to evaluate an algorithm if it doesn't place bets at a certain frequency. And if I'm below 5% turnover, then it means that the frequency of my bets is just so low that it's harder to evaluate the algorithm correctly. Another important measure, of course, is beta, making sure that I'm not too correlated to SPY. And if we can see here, it looks like I am for quite a while below the minimum limit of beta, which means that on the short side, I have too much correlation to SPY. So it dips all the way down to minus 0.86, when what we really want is to keep it between minus 0.3 and plus 0.3. The next one that's important for us is position concentration. So we want to make sure that every algorithm, doesn't have excessive position risk, and because there may be something that makes great returns but is only trading a single stock or two stocks, and that is very overexposed to any events that are specific to that company. If in case something goes wrong there, it could mean the whole algorithm comes crashing down. And as we can see, my algorithm right now has a pretty high position concentration, because I think it goes all the way up to around 76% in a single name, which is an 84% in fact in 2015, which is way higher than we would like. So that is far, far above the contest limit of 5%, and is something that I want to bring down. The final one in risk that I am also not meeting is the net dollar exposure, which is basically talking about how I am, is basically talking about the difference between my longs and my shorts, like how net long or net short am I. So as we can see here, I seem to be, failing this constraint both on the negative and positive side. So I need to stay within that 10% constraint, which I'm not doing right now. We can also take a look at the algorithm's performance outside of these constraints. Everything that you see here doesn't have a specific number that you need to meet, other than the fact, of course, that the algorithm needs to make money over its lifespan, which is self-explanatory. So returns need to be above 0. But besides that, everything on this screen does not have any specific number tied to it. I'm just going to walk through what each of these things represent. So total returns, I think, is pretty straightforward. It's just the difference between your portfolio value at the beginning of the backtest and at the end of the backtest as a percentage return. Specific return is a little more interesting. It basically talks about the difference between your total returns and your common returns. And common returns are something that we can see here. So common returns are any returns that you get from just being passively exposed to one of the sector or style factors. And just to revisit what those are, these are the sector factors, various sectors of the economy, like basic materials, consumer, cyclical. And style factors are common investing styles like value investing, momentum, etc. So one thing that you often want to do is to try and have a high specific return and a controlled common return. You don't want all of your returns to come from the common return, because that means that you're just essentially passively exposed to some well-known investing factors, whether they be sectors or styles, and maybe the algorithm isn't doing as much unique as you would like. We can also take a look at my rolling Sharpe ratio, which in many cases is more useful than the point metric because you can see how my Sharpe changed over time, and pretty dramatically. In fact, it goes all the way from 3.2 down to minus 0.4. So there are some meaningful swings here, and we can also get a sense of the highest drawdown that was there in my portfolio history. So it looks like the worst drawdown that I've ever seen was in January 2015 when I hit a minus 22% drawdown. And so that's kind of where my algorithm is right now. It has maybe some interesting facts about it, but it's not meeting the contest criteria. And as it stands, it would not get into the contest. So how would I go about fixing that if I wanted to change things? So we could look at the learn how links that are provided in each of these tabs. So for example, it says here that to be eligible for the contest, I need to trade within the tradable universe. And there's a link for me to go to learn how. So I head over there, and this takes me to the contest tutorial, which is a great resource. And I recommend that everybody uses it if you want to write algorithms for the contest. And the big thing here I can see is why I need to invest in the Q tradable universe. But also I get a sense of what I need to do to be able to meet that requirement. So if we look at an algorithm that actually meets this requirement, we can see that I've done that, and I've set my base universe to be the Q tradable stocks US in my pipeline. So that means that I'm saying that all of my stock screening should be done within the Q tradable, and I trade within that subset of stocks. And likewise, I can go through that for each of my other missed constraints. So if we return to my algorithm, we can see that I also missed out on position concentration. This one was pretty dramatic because I was way over. So I can go to learn how. I understand that I don't want to be overexposed because I want to have minimal position risk. And it tells me that the way to fix this is by introducing a position concentration constraint into order optimal portfolio. So if we revisit the code here, we can see that I've actually done that, and I've added this constraint position size constraint to my list. And what this is essentially saying is that I want to limit my max short and long position sizes to a fixed amount. And in both these cases, we've said that they should be not more than 1% in any one stock. And going through this, we see a bunch more constraints. There is the long short constraint, which I fixed here through the dollar neutral constraint. The turnover is a little interesting because there's no constraint that you can apply, or you may not necessarily need to apply a constraint to keep your turnover within the bounds. The best thing to do here is often to just schedule your trading at a frequency that matches the turnover constraint. So that might mean that usually you want to trade either daily or weekly, and you'd probably want to play with that to see what turnover number actually works best for your algorithm. The next one is leverage, which also I was missing out on. Leverage is a little interesting because on the max side, you can constrain it using an optimized constraint, which is constrain gross leverage. So there I'm saying that my gross leverage should be no more than 1. And that's accounting for the fact that between trades, it may creep up, just due to changes in my position values. But one way I can control it on the minimum side is by making sure that I am investing, that I'm making sure that I'm investing in enough names that I can deploy a good percentage of my capital and keep my minimum leverage high enough. So going back to this, another one that I failed was beta to SPY. And once again, I can just hit learn how. I come here and I see that the way in which I need to meet this beta neutral constraint is that I would define a beta to SPY factor, which if we go down a little bit, I've done here. And then I need to essentially define a constraint that says beta neutral, and which is essentially a factor exposure constraint to the beta factor that I defined above. So I've defined that this factor tracks beta to SPY, and I want to constrain my exposure to that factor to like plus or minus 0.5. And in here, I've added that beta neutral constraint to my algorithm. The next one is one that you can tackle a lot of exposures in one go. So when we looked at sector and style exposures, you can see that there are a whole bunch of them. And these are all the factors that make up our Quantopian risk model, which basically talks about all the various common investing factors that can contribute to a strategy's return. So those are all of the economic sectors as defined in our model and 5 major investing styles. So what I want to say is that I want to limit my exposure for all of those to some kind of reasonable extent. So I don't want to be riding too much on any one sector or style. So in this, I've just chosen to use the default risk model constraints, which are plus or minus 18% for sectors and plus or minus 36% for styles. Both of those are good because they keep me under the contest limit, because the contest says that you can't go above 20% for a sector and 40% for a style. So I'm staying about 10% under that to make sure that I have a little leeway there. So with that, I get to a place where I've added all these constraints to my algorithm. It looks a lot more robust. And now when I look through my returns, I can see that I meet all of the constraints. So we look at structure. I am trading now within the tradable universe because I added that to my base universe screen. I am ordering with the optimize API as I was doing before. If we look at risk now, the numbers look a lot better. So all of my sector exposures are well within this band of plus 20 to minus 20%. So that's keeping me pretty controlled to each of the sector exposures. Likewise with style, there is still some fluctuation, but it's very much in the acceptable range, and nothing ever crosses the 40% mark. Leverage is actually pretty well constrained. It's always within this sort of band of 0.8 to 1.1. And likewise with my turnover, I'm keeping it roughly steady at somewhere between around 25 to 30%, which is well within the restriction that we have, which is 5 to 65%. Beta to SPY again is comfortably within minus 0.3 to 0.3. Position concentration has dropped really dramatically. I think the highest that I ever go to is 2.18%, which again really isn't that high. So I'm pretty comfortable there. And even with net dollar exposure, I'm never going too far net long or net short. So I'm pretty market neutral in that sense. You can also take a look at my performance. The max drawdown has definitely reduced. There is still some fluctuation in the Sharpe ratio of the graph, which is something that we could probably look at improving. Common returns are there, specific returns, and of course they sum up to make the total. One thing important to remember when you're looking at algorithm performance, especially things like return and Sharpe ratio, is that all these numbers are in sample. So don't be tempted to over optimize them, because you don't want to run the risk of overfitting your algorithm and making it great over the sample data, but fail over the out of sample. So if you'd like to know more about what you can do to prevent overfitting, there's a great lecture that we have on our website called The Dangers of Overfitting, which I would highly recommend reading through. One of the best ways you can sort of start to do that is kind of the machine learning approach, where you pick a training set initially to work with your model on, and then once you're confident that your model works over the training set, you validate it over a different testing set. So for example, in this case, I've chosen to backtest over 2014 to 2016, which could be a good training set, and I can keep improving my model there. And then once I feel that it's good over this period, I can then switch it over to a totally different time period and see if it still works over that new time frame. And that can help me give me an idea of whether I've been overfitting my model or actually have come up with something that is durable and lasts through many time periods. So at this point, I'm in a pretty good place to enter the contest because I have 3 green check marks. I'm meeting all 9 of these constraints, and I also have positive total returns. And you can always hit enter the contest to do that. Before you enter the contest, I would recommend running a backtest that matches the contest selection parameters. So to do that, you'd want to run a backtest that goes 2 years back from the present day. So today is May 15th. So you'd want to run a backtest that goes from May 15th, 2018 through to May 15th, 2016. You'd also want to run that over $10 million capital base. And For the purposes of the contest, we use the default slippage and commission model. So if in case you're using any custom slippage or commission model, then make sure to turn those off if you want to evaluate your contest eligibility, because that would give you the clearest picture. There are also a few other things that you can do from this page. You can, share your results if you'd like to post what you have to the forums. You can take a look at what parameters you ran your backtest with. You can also see when it started and finished in real time. So this one took about 8 minutes. And you can go back to your list of all your backtests. So this pretty much covers structure, risk, and performance. And these are the tabs that you'd really need to help you get into the contest. And once you get sort of green check marks for all 3 of them, then you're good to go. There are a few other features that we've also introduced recently. So there's the activity tab, which kind of contains the meta information about your algorithm. So you will be able to shortly view your transactions and your positions in a nice interactive table. That feature is coming soon. We expect to have it out shortly. You also get to see your logs streaming through. So here actually it turns out that I'm using an old version of the Qtradable stocks US, which I should fix. And it looks like I have an expired asset in my optimization universe. You also get to take a look at your algo code, which you can also, you can also go back to the IDE by clicking on your algorithm name. But if you just like to see a snapshot of your code, you can see it here. What's really interesting is that you have access to a research notebook within your backtest screen. So you can easily flip back and forth between, say, like your overview here and your research notebook. So for those of you who aren't familiar, on research, you can get access to your backtest positions and manipulate those with Python. So I run this function called get backtest, and I pass in my backtest ID. There are a bunch of interesting things I can do with this here. So one thing that I've done in my backtest is that I've recorded the number of longs and the number of shorts I have on any given day. And I can access that using bt.recorded vars. I run that and I get a data frame of all my recorded variables. I can also do any kind of, it's basically like any kind of data that you can manipulate with Pandas. So if I want the average number of longs I had over the course of the days, I can just do the mean of my long count and I get roughly around 50 longs a day. I can also do things like access my positions and transactions. So these are my positions, and then I can access my my transactions as well. And then you can of course break these down into you can manipulate these in any way that you'd want to manipulate a standard Pandas data frame. So if I wanted to see all the unique stocks that I held over the course of my backtest life, I can do that and get this array of SIDs. What's also really powerful, as some of you may know, is that you have access to Pyfolio in the research environment. So Pyfolio is essentially this tool where you can run these things called tear sheets on your backtest, which what a tear sheet does is, given your backtest positions, transactions, and other information, it will essentially spit out a graphical analysis for you that goes pretty in depth and oftentimes goes beyond what you see on the standard backtest screen. So in this case, I've asked it to create a simple tear sheet for me, which doesn't contain all of the analyses. If you want more, you can do create full tear sheet instead of create simple tear sheet. But in this case, I can see a whole bunch of new metrics about my backtest. I can see things like kurtosis, the tail ratio, value at risk, which are not applicable for, or which don't matter for the contest criteria, but are always useful for you to know as you evaluate and try to improve your algorithm. I can get a sense of how my backtest compares to various, various benchmarks or other comparison points that I would like to make. There's rolling beta, rolling Sharpe. I get a sense of all my various underwater periods and how bad they've been. You can also see your net long versus short exposure, see the top 10 holdings. So, it looks like I have GEVA and LINE, Solar City is some of my top holdings. So there's a ton of useful information in this tear sheet. If you want something that's a little more tailored to the risk model, you can also do create perf attrib tear sheet. So this will give you something that essentially plots your risk exposures and returns from each risk factor over time. So if you'd really like to drill into the risk model in more detail, this is a very good place to go to. And if you kind of like the full tear sheet and every single thing that's available, then we recommend running create full tear sheet. So I think that that pretty much covers what you can do on this new screen. And again, our hope is that it makes it a lot easier to enter the contest. And the best way I would say is if you're failing a criteria, click on Learn How. There's often a lot of help in the tutorial, and keep working towards getting that next green check mark. And once you have all your green check marks, then you can you can enter the contest and hopefully do very well there. So I think that's pretty much everything that I had, and looking forward to taking any questions.
So we really received like one question. Now I think a couple more are coming in. If you have a question, please type them in the questions sidebar, and then Abhi will get to them.
So one of the questions that came in is, can you post the before and after versions of this model online so we can review it in detail? So I will be posting this after the webinar. I'll post it into the forums, and you can see the algorithm that passed all of the constraints as well as the one that failed most of them.
All right, I think that's all the questions for now. If you have a question that's not really related to this webinar, you can always email us at feedback@quantopian.com, and we will answer you quickly. Thank you again, Abhi, and once again, this webinar was recorded, and we will be sharing that with everyone who registered in the next few days.